This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Michael back on the show. Now, listeners, you're going to find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Michael's picture saying looking for the downloads.
Patrick, what was your main takeaway from Michael Howell's interview, and how can we design a trade to express that view?
Well, Eric, the big takeaway from Michael Howell is that the Fed is shifting into a regime where cutting rates becomes not just likely, but necessary. Liquidity pressures in the repo markets, accelerating treasury issuance, and a policy pivot towards supporting Main Street all point to the same direction. Policy rates are heading lower and probably faster than the market is pricing. So for this week's trade, I want to position directly for that outcome. Now, just yesterday, the odds of a December cut have faded after the jobs report got pushed into mid-December, and that timing kink has completely scrambled the front-end narrative. But in the bigger picture, that kind of short-term confusion is the opportunity. The December 2026 SOFR contract is trading around 96.90, implying 310 basis point Fed funds at the end of next year. The trade here is straightforward. Markets are still underpricing the probability that the Fed will be forced into a much more dovish pivot. Whether it's liquidity stress or collateral dynamics, the setup argues that the strip will need to reprice lower policy rates on the order of another 50 to 100 basis points of cuts being baked in. So the play is to own the convexity now while the market is temporarily distracted by a timing noise rather than the bigger macro shift. To express that view cleanly, I'm looking at the 3-month SOFR December 2026 97.5 to 98, 50 basis point wide vertical call spread. It costs 8 points, which means that you're laying out 8 basis points of risk to make a potential 42 points profit, roughly a 5-to-1 payoff if the rates markets price in deeper cuts. It's a capital efficient way to own the dovish pivot narrative with fully defined risk.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent trade of the week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's get into these equities. What are you thinking of the markets here?
Patrick, I think it's really important that we keep a close eye on what happens next in the equity market because, last week the story was, look, okay, as soon as we get the government shutdown resolved and the government reopens, it's going to be off to the races and everything's going to be fine. That's what happened, and it lasted for about a half a day, and then we were rolling back over. And then it was, but that's just because the market's waiting for NVIDIA earnings. And once we get NVIDIA earnings, if we get a positive print there, it's all going to be fine. The market's going to be rally. It's going to be great. Okay, now we've got an absolutely outstanding NVIDIA earnings print. So the market is supposed to recover. Well, look, we've been struggling below the 50-day moving average. This is the first time we've seen a breakdown to the downside below the 50-day since the 21st, I believe, of February. So the operative question, I think, is can this market get back above the 50-day moving average and stay there? And that means we need to see a pretty brisk rally from here. If we don't get it, in other words, if the market expectation was that as soon as the government reopens, it's all going to be fine. Oh, wait, that didn't work. As soon as NVIDIA earnings comes out, it's all going to be fine. If that doesn't work either, I think we really have to question where this market is headed and how much lower can go. But Patrick, you're the technician in the house. How much concern or non-concern do you have about the first daily close below the 50-day moving average since February?
Well, Eric, we've now officially had our first 5% market correction from peak to trough and a short trip below the 50-day moving average. But here are some of the bigger picture things that we can't lose sight of. One, market breadth continues to deteriorate. We're at 34% of stocks above their 50-day moving average in the S&P 500, which means basically 2 out of 3 stocks are in a definitive downtrend. While NVIDIA has certainly spurred the market cap weighted S&P higher and the NASDAQ a little bit higher on its positive earnings reaction, we still have a definitive downtrend and very little reaction to things like the equal weight S&P 500 index or the Russell, which both are in clear breakdown mode. The financials continue to be very weak. So the underpinning market is structurally very, very weak. Now, think back to December of last year where we had a similar type of a drop going into the Christmas period below the 50-day. The market mustered up a rally all the way back to its previous high for a double top retest. That prolonged the whole sequence by a month, but inevitably the market correction did start in February of this year when that became that Liberation Day market drop. In the same manner, we may very well still be in a bigger topping formation, and maybe NVIDIA has lightened up some of the pressure, which may allow this market to do some retesting of its highs, but it's incredibly premature to start making a bull case narrative. If anything, I think this is a bigger topping formation that may define the fourth quarter. All right, Eric, let's talk about this dollar.
Well, the Dixie's back up to flirting with 100 again, actually above 100 on Wednesday afternoon, but still hasn't broken out to the upside, at least not yet. The dollar trend reversal to the upside or the continuation to the downside is going to drive a lot of other markets in the opposite direction. So we really need to see what happens next here and watch the dollar closely. And as of recording time early on Thursday morning, it looks like the rally may be continuing and we might be starting to see that upside breakout on the dollar. If that happens, it could be bad news for other risk assets.
Well, in my eyes, Eric, this dollar breakout is for real. And this actually is something that should be a caution for bulls because the reflation trade has been dominant for the last 9 months, and it was all backed on a weak U.S. dollar. Now, if this U.S. dollar breakout gains any momentum, it certainly is going to be a headwind for almost all of those investment themes. Now, overall, we have a fresh breakdown in the euro, almost breaking to a lower low. The pound sterling definitively already broken down. A U.S. dollar yen that is absolutely screaming higher. The U.S. dollar against the Canadian dollar turning up. You basically have synchronized U.S. dollar strength right now, right across the board, and it may only be gaining momentum. There's going to be a lot of knock-on effects from an intermarket perspective. This cannot be ignored. Keep watching this U.S. dollar for a potential bull continuation. All right, Eric, let's talk about oil here.
Well, it looks like the price of crude is trying to firm up again, both flat price and front of curve time spreads moving back into backwardation, at least for the first several months out on the curve. I place more credence on the latter, that is the time spreads, than on the flat price. And let's see what happens here. But it looks like maybe oil wants to make a recovery here. Per Michael's comments in the feature interview, commodity outlook should be bullish from here. But wait a minute. Trump badly needs and wants lower gas prices into the midterm elections. And it's very clear from President Trump and Secretary Bessent's comments that they want to pump up Main Street, not Wall Street. So, and I think that extends to they want to pump up Main Street as opposed to doing favors for their buddies in the oil patch. So I think the writing's on the wall here with MBS in town meeting with the president. Maybe some kind of deal, invisible hand is in play here, and a deal has been struck to allow oil prices to continue to move lower into the midterm elections, get gasoline prices in the U.S. down under $2, and then run it back up after the election. Obviously, that's wild speculation on my part. I have no evidence to support that, but as far as I can see, the handwriting's on the wall.
Well, Eric, crude oil remains at the bottom end of that range. Now, what's interesting is the last 1 month consolidation, which had every opportunity to legitimately break down and start selling, sending the crude oil down to $55 or lower. It hasn't. And in fact, every time crude oil has done a breakdown candle, the bulls have quietly bought that dip. And generally, the $58 to $59 level has been defended. What we're going to be watching is whether or not the bulls can actually attempt a breakout candle. Now, that has not come yet. We still have no violation of the descending trend line connecting all the highs. It's still below its 50-day moving average. The primary trend is still down, but it is no longer in sell mode. It is in a quiet accumulation phase. And I'm going to be watching for whether or not some catalyst, maybe like an attack on Venezuela, could spark a short-term breakout that could feed into a short squeeze on the upside. Now, Eric, let's move on to gold.
Looks like we're starting to form a pennant or symmetrical triangle formation on the gold chart. I still think there's lots of upside left to go in this bull market. Michael agreed with that in the feature interview. So let's see what happens. But, this isn't resolved yet. We've seen a correction that who knows how long it's going to last. The last correction in gold took us quite a bit lower before it resolved. And we're right kind of, I think, on an inflection point. Looking at the chart, we need to see this sustained uptrend and stay above the 50-day moving average. As long as that happens, I think maybe it's upside from here, but there's plenty of room for more downside without breaking the longer-term bullish trend.
What's interesting about your view about the pennant or symmetrical triangle formation is that that's exactly how the previous 3 consolidations in gold have played out. Now, what supports that is the fact that these dips are being bought. It is holding above its 50-day moving average, and so it is generally being defended. Overall, the previous gold consolidations lasted anywhere from 2 months to 4 months. So I would just basically expect that there's going to be continued gold consolidation into December, and at some point in the first quarter of next year, there will be another opportunity for gold to break out again. Right now, just expect more of this kind of ping-pong match between support resistance levels as it consolidates into the Christmas period. All right, Eric, let's move on to uranium.
Well, Patrick, I'm adding to my longs here. Frankly, I'm not sure if this correction in uranium and uranium miners is over. The big risk to it was an unwind of the AI trade. Now, we just saw a really positive earnings print from NVIDIA, so it seems like the AI trade is not unwinding quite yet. And URA, the uranium ETF that has the most liquid options chain, has gone from overbought to oversold. I really like the 50 and 55 strike calls here. The market started to turn back up on Wednesday afternoon. Let's see if that lasts into Thursday. Especially on the back of NVIDIA, we want to see a brisk rally from here. Now that the question of AI falling apart seems to be at least on the back burner. If that doesn't happen, it makes me quite concerned that we could see a much deeper correction before this is over.
Well, certainly, Eric, now that we have pulled back 30+% off of the highs on the URA, that there is certainly the opportunity to start entertaining the idea that there's going to be levels here that are buyable. Overall, though, the price action remains distributive, so it's a very early speculation about catching a bottom. I'm going to be watching to see whether or not the price action really starts to show that the price levels here are being defended, and this is going to be where the bulls are going to take a stab at getting this back into bull trend back above the 50-day moving average. This is certainly a tactical moment to see what happens, but I'm a little bit more of a wait-and-see mode here on this. When we specifically look at that Sprott Physical Uranium Trust, that has been in a much bigger consolidation for a month. I generally am more bullish uranium prices because I simply think there's more asymmetry in the opportunity here, but certainly if you're looking for the higher implied volatility in your returns, then accept no substitute for those uranium equities.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Yeah, well, Eric, on that 10-year Treasury yield, ever since the last FOMC meeting, we've basically seen the 10-year Treasury yields rising, but that we still haven't seen a legitimate sequence of a higher high where a new bull trend has started in the yields. Overall, this was a very oversold kind of market that is now counter trending, and with the fact that the jobs numbers have now been pushed out to middle of December, increased likelihood that the Fed just holds on the December meeting means that all of the rates markets may actually just be muddled in here for the remainder of the fourth quarter, and that the next kind of major move in yield markets is going to emerge in the new year. So at this moment, could we still see a quick rip to the 4.25 level on the upside of the yields? It's totally on the table, but generally, I think that mean reversion and it trading more or less around this current level for the next month is probably the most likely outcome.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.